Howdy, everybody. Welcome to the Liberty Call. Today is Wednesday, Hump Day, May 21st, 2025. Hope you're having a fantastical day out there in the interwebs. It's a pretty nice day here in Colorado, folks. If you're down along the Gulf Coast, you may want to make a trip up to Colorado. It is beautiful this time of year. So, anyways, all right. Well, markets sank hard today as rising bond yields and debt worries sent stocks tumbling. Oh, no. A weak Treasury auction spooked investors while Target and Carter's cratered on poor earnings and tariff fallout. Tech took a hit with Wolfspeed collapsing nearly 70% on bankruptcy rumors. Meanwhile, Bitcoin hit a fresh record high of $110,000. And the IMF warned the U.S. To get its fiscal house in order. So before we break all the news down, I need some help from you. Yes, you. I see you sitting there listening to me ramble on, blah, blah, blah. I need some thumbs up. Like, share, subscribe, and follow, and press that notification bell. I forgot what I normally say. All righty. Well, let's get to markets. Here we are. Dow Jones finished the day down 1.91%, 817 points. Oh, my gosh. Closed at 41,860. S&P 500 was down 1.62%, 96 points. Closed at 58.44. NASDAQ down 1.41%. 270 points, closed at 18,872. The VIX was up 14.76% today. It's at 2076. Canada down 0.83. Brazil down 1.62. And our friends to the south in Mexico up 0.34. Headed over to Europe, Germany up 0.34%. The UK up 0.06. France down 0.4. Netherlands up 0.24. Spain down 0.11, Italy up 0.07, Switzerland down 0.27, and Portugal down 0.26. Russian exchanges were split today. The MOEX down 0.41, RTSI up 0.28. And our overnight markets, starting with the Nikkei in Japan, it was down 0.61%. Australia up 0.52, New Zealand down 0.31. In China, the Shanghai up 0.21, Shenzhen Component up 0.44, China A50 up 0.69, DJ Shanghai up 0.19, Hang Seng up 0.62, and the Taiwan weighted was flat up 0.01%. All right, so those are our markets. Kind of a me day here domestically. The rest of the world was doing all right. Let's hop into our market recap. SP 500 cut some losses as Alphabet leads tech recovery. Everything was still way down. The S&P 500 trimmed earlier losses Wednesday, buoyed by a rally in tech stocks led by Alphabet, while investors digested mixed corporate earnings, rising treasury yields, and persistent macroeconomic concerns. Alphabet surged over 4% following its latest product event showcasing AI-driven innovations aimed at maintaining its edge in the artificial intelligence race. In contrast, Microsoft remained flat after disclosing 100,000 Windows devices were infected by Luma malware. That's good news, isn't it? I wonder if there's a way to get it off our devices. I guess I'll check that after I'm done with this. Retail earnings painted a mixed picture of consumer sentiment. Lowe's posted stable first quarter sales and flagged ongoing uncertainty. Target stock fell after slashing its annual sales forecast amid weak consumer confidence and declining discretionary spending. Walmart and Home Depot previously noted pricing pressures and supply challenges linked to tariffs. Investors remain cautious following last week's U.S. credit rating downgrade by Moody's, citing mounting debt. The House prepared for a contentious vote on President Trump's massive tax cut and spending bill, projected to add $3 to $5 trillion to the $36.2 trillion federal debt. The Federal Reserve signaled a continued pause on rate cuts due to inflationary risks from rising tariffs and trade uncertainty. Meanwhile, China warned U.S. chip restrictions threatened last week's trade truce, complicating negotiations with Japan and other countries. Palo Alto Networks slipped on higher expenses. Xpeng rose after posting better than expected results. Take-Two Interactive dropped following a $1 billion stock offering. Baidu climbed after strong AI-driven revenue, and Snowflake reports after the market closed. Overall, tech optimism was offset by lingering macro headwinds, leaving markets in a cautious holding pattern. Yeah, and then they took a real dump at the end of the day. Well, most of the day. All right, next up, got a research report here. EIA reports unexpected rise in crude oil inventories and the markets react. This comes to us via investing.com. The Energy Information Administration reported an unexpected increase in U.S. crude inventories this week, defying market expectations of a drawdown. Commercial crude stockpiles rose by 1.328 million barrels, contrasting with analysts' forecast of a 900,000 barrel decrease. This surprise build suggests weaker than anticipated demand and could weigh on crude oil prices. Previously, inventories had climbed by 3.454 million barrels, so although the latest increase is smaller, it still marks a deviation from anticipated trends. Markets had been positioned for a drawdown, which typically signals stronger consumption and supports higher prices. Instead, the inventory build points to potential softening demand, creating a bearish pressure on oil markets. Crude oil inventory levels are a critical indicator for petroleum prices, which in turn influence inflation. Well, I don't know if they influence prices. I don't know if they influence inflation is when you increase or decrease or increase the money supply or decrease the goods. So let's see here. Higher stockpiles generally depress prices, while tighter inventories tend to drive them up. Given that energy costs are a major component of inflation calculations, this unexpected rise could moderate some inflationary pressures if it leads to lower fuel prices. Market participants will closely scrutinize upcoming data releases to assess whether this trend continues or reverses. For now, the surprise inventory build has injected new uncertainty into oil price forecasts and inflation expectations alike. Again, I wouldn't necessarily say inflation, simply because inflation is when you have a change in the system, as opposed to just prices going up because people are buying more of, because people are buying more of it. All right, one last article. The Trump GOP's great big ugly debt bomb. This comes to us via LouRockwell.com. Mr. David Stockman, a very, very bright individual, put this together. So let's see what David has to say. All right. David Stockman excoriates the Republican Party's fiscal agenda under Donald Trump, warning that their proposed big, beautiful bill, that's in quotes, is nothing short of a catastrophic debt time bomb. I kind of agree with him. He begins by referencing the Congressional Budget Office's, the CBO, latest baseline, which projects federal deficits reaching nearly $3 trillion annually by 2035 and a staggering $58 trillion total debt load, up from $37 trillion today. Stockman argues that instead of cutting spending or reforming entitlements, the GOP is pushing for even more red ink. Yeah, that's always a good sign. The bill would extend the Trump 2017 tax cuts, costing $5.1 trillion over 10 years, once all revenue losing measures are included. I mean, and actually those Trump tax cuts actually, for people who make, over $100,000, you were probably, losing out because you lost out on your SALT deductions and things like that. So anyways, where are we? Any theoretical spending cuts, Medicaid, food stamps, student loans, are overwhelmed by permanent increases in defense, border security, and other pet projects. Worse still, the bill uses fiscal cliffs and gimmicks to disguise long-term costs, assuming provisions will expire in 2028, even though they're likely to be renewed. There's nothing so permanent as a temporary government program, so that's always something to remember. Stockman dismantles the GOP's claim that economic growth will offset the deficit explosion. Real GDP and wage growth have slowed since the 2017 tax cuts, while business investment has declined. Corporations funneled post-tax cut windfalls into stock buybacks and dividends, not productive capital investments. Nominal GDP is unlikely to exceed the CBO's 4.2% growth forecast, especially with the Fed sidelined due to inflation. Ultimately, Stockman argues that the Trumpified GOP has abandoned any semblance of fiscal responsibility, like they ever had any, by combining deficit finance tax cuts with inflationary tariffs and spending hikes. They've embraced a delusional growth narrative that will instead lead to economic disaster. Stockman predicts the U.S. bond market will collapse well before 2050 as investors flee unsustainable debt levels. He warns the Trump-backed reconciliation bill is, quote, the most wanton act of fiscal perfidy ever committed, end quote, and a looming economic avalanche for America. Wow. He didn't pull any punches there. I totally agree. I mean, continuing to ignore the problem and just allowing it to snowball is probably the worst thing ever. What I would do is, if I was in charge, yet no one has asked, I would close every agency that is not outlined in the Constitution. So pretty much all we would keep is the Department of State, the DOD, And I mean, and with the DoD, you got to get, you have to do a congressional amendment for the Air Force and Space Force, since those weren't originally part of, and before you say the Marine Corps is part of the Navy. So, uh, so anyways, I get rid of everything and just pay down until we pay down the debt down to as close to zero as possible. And then we'll evaluate whether or not we want to start adding agencies back to the federal, to the central government. So, and then you would need amendments to actually establish those, FBI, CIA, all that crap. So, anyways, all right. Well, that's everything that I had to ramble on about for today. So, if anyone needs anything from me, financial planning, investing, all that good stuff, here, where do you want to go? DSAFinancialGroup.com. That's where you want to go for all your financial planning needs. So, give me a buzz. I'd be happy to help. All right. Well, hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.